Oh, hold on, bro. Hey, welcome. It's Friday. It's Jobs
Hold on. I
Friday.
said hold on. Go back and hold on.
Josh, here we are. So happy Friday, guys. Welcome to the Educated Homebuyer Friday weekly edition. This is us kind of recapping what's happened this week so that as you go into the weekend, you have an idea of what you need to do with regards to locking rate, just kind of following the market. And today, we got some big numbers coming out on the jobs front that's actually helping the bond market. It's helping interest rates. So Josh, why don't we just dive into it?
Yeah, let's go back and just start. We knew so last week when we were here giving you guys the weekly update, we basically said another boring week, the 2 out of the last 3 with no data, and knew that was the calm before the storm. We had a big week. So nothing really came out Monday, but we had jobs week with inflation data in the form of PCE. So Tuesday we got job openings, the JOLTS report, job openings dropped to 7.44 million, the lowest since 2021. Quit rates are still down at 2%, meaning people don't feel super strong in their jobs. They're not wanting to quit. They're not wanting to go chase other jobs. So softening. It doesn't tell us we'll get a terrible weak labor market, but definitely softening. So Wednesday, some more labor news and the Fed meeting, Jeb. So ADP came out, said 75,000 private jobs. And then they revised June. June wasn't quite as bad as what they had said. But when we look at those numbers, the 12-month average for ADP is like 107,000 jobs, 112,000 jobs a month. The 6-month average is down to like 67, and the 3-month average is down to like 35,000. So that was important. But ADP is kind of a back burner number, a high correlation to NFP over the long run, but not necessarily in the short run. But hold on to that thought, because we're going to see that it was tightly correlated to what we're walking away from today's jobs data with. Fed came out, did absolutely nothing, which was as expected. The market improved a little bit on the announcement, but 30 minutes later, they start the press conference, and Powell was more hawkish than most people thought, or at least not dovish like they were hoping. And we left that meeting not just with rates the same from the Fed's perspective, but also the futures market had gone from expecting 2 cuts between now and the end of the year down to 1. That's another one. Hold that thought. We're going to review that here in light of today's jobs data. Yesterday, the important news was PCE. Core PCE is the Fed's preferred measure of inflation. Basically came in right where expected, 0.1 higher, but it wasn't so much in the month-over-month data. It was the rounding in the year-over-year figures shaking out. Consumer spending steady, but at low levels. Really everything that you look at there, the only thing that was negative possibly in that the market could not have liked, despite the fact that the market improved a little yesterday, was the fact that goods inflation is up a little bit. We're finally seeing a weakening, a softening of services inflation, but goods inflation is up a little bit, most likely because of the tariffs, and that's Powell's concern, that the tariffs are going to be pushing inflation higher. So now that all was just prelude to today, Jeb. We got the non-farm payroll data. The headline is 73,000 jobs instead of 104. That's a miss. That's weak, but it's not horrible. We didn't lose jobs. So the big market mover is in these downward revisions. So net revisions to the last 2 months for about 139,000. So 139,000 jobs reported in June is now 19,000. They dropped that 120,000 jobs just for the June report. The 147 reported last month revised down to 14,000. So on average, 125,000 less jobs the last 2 months than what was reported. And we talk about this. These revisions usually get ignored by the market. They usually come way after the fact. The interesting thing today is big, heavy revisions fast and right on the heels of today's data being weak to begin with. So from there, if we want to look at Fed funds futures, Jeb, we've got, boy, oh boy, here, let's actually do this. I can share it with you guys. Where's my share? Let's see, Fed watch.
Well, while he's doing that, I mean, unemployment basically stayed the same, 4.2. The revision's the big thing there, Josh. You know, I don't like that screen. Let's change that to our other, where we're actually looking like that. There we go. So you get a little bit better view of it. But regardless, I mean, all of the data has helped mortgage rates, which we're going to talk about here in just a minute. But let's talk about this. So we went from 1 cut on Wednesday to now potentially 3 cuts by the end of the year.
So basically an 80% chance, 82% chance. And remember, this fluctuates from day to day. On Wednesday, you were looking at this and they were projecting no cut pretty much in September. 82% chance as of right now, 60% chance for another one in October, and a 46% chance of another in December. So we talked on Wednesday, Jeb, that this Fed meeting was less important because it was kind of telegraphed what was going to happen. They weren't going to do anything. And most importantly, with no meeting next month, we're going to have 2 rounds of PCE, 2 rounds of CPI, and 2 rounds of jobs reports before the next Fed decision. So they have been known to pivot very quickly when they see revisions like this. So I would say at this point, it's pretty much baked into the cake, this quarter point cut at the next meeting. So we've talked about, for you as a home buyer, you in the market right now, this means nothing because the Fed hasn't done anything. But Jeb, you had mentioned here interest rates. And if we look according to Mortgage News Daily, and they'll adjust this again here at the end of the day. But for that right now, they're reporting 6.625, and that's down just less than 0.25% over the week and 0.1% just over yesterday. Quoted a bunch of people yesterday, and they're at least 1/8 better today. The FHA and VA loans, 6.25. We locked a bunch of them in the very low sixes, lower than that this week. So you don't need to wait to benefit from this. Your rate sheets are already going to be reflecting this market action as of today.
All right, Josh. So we've seen a lot of volatility in the market. We've seen moves like this in the past. Interest rates have come down. People thinking, hey, I'm just going to sit on the sidelines. I'm going to wait for further action, revisions, whatever, to interest rates so that I can lock in an even lower rate. As a betting man, as a non-betting man, what are you doing right now? Are you locking these people that are under contract today, or are we floating through the weekend with hopes that the trend continues? Because next week we go kind of back to that lighter week with regards to data. So what are we thinking?
I always, when we get a move like this, if you haven't already locked, I would say don't lock until you see some weakness. We don't need to give this all back before we decide to lock. But generally, we show the bond charts on here. You and I are looking at charts all day, every day. There's different ways to draw on different levels of support and resistance. Our friend Matt Graham over at MBS Live thinks it's all voodoo and the market's going to do what it's going to do based off of the data. And we just got a giant dose of data. And like you said, a slower week next week. If we close near the best levels of the day, it's generally indicative that there's more strength there and potential follow through buying. If we were to give away a third or a half of these gains before the market closes at 2 p.m. Pacific today, I would be more concerned and more leaning towards locking. So a bunch of people did lock earlier this week because rates had improved. We're in the middle to the lower end of the range of where we've been over the last couple of months. And several people got under contract this week. And I give them the option, say, here's the reality. That report has been higher than expected, the last 3 months. Now we get these giant revisions. We see it wasn't really higher, but at least what they were reporting. So there's the potential that despite what we see, boots on the ground, what you feel in the economy, that the labor market is weaker than what's being reported. There was always the possibility of another stronger than expected report, and we could have been back towards the higher end of the recent range. So a lot of those folks locked, and we always tell them this is important for you to know. If you're someone who's risk averse, you are not a gambler, you are not comfortable with risk, and we have an event coming up like this, it's probably better to lock. If we get a big move, so bigger than just what we saw today, we said day over day, 0.8% improvement in rates. If we get 1/4 to 3/8, you're going to be able to renegotiate and get a good chunk of that. So you locked, you protected yourself so nothing gets worse, but we can renegotiate once we start seeing 0.25% plus of improvements in rates. So hopefully that answers your question, Jeb. I want to turn the question back on you in a different way. Those people, just a small subset of our audience, is going to say, hey, I'm going to wait till rates get better, and then I'm going to go out and find a home. So we've seen this. We've seen these sort of head fakes where we get a nice improvement and then we give some of it back. Nice improvement, we give some of it back. We haven't had a long protracted run since late last summer, early fall, July, August, September of last year. We had a nice 60-day run where they just kept going in our favor. When you are dealing with the buyer who's saying, hey, I'm waiting for rates to get better. What are you advising them in the current market when it's a tight, there's much more inventory than there was, but still a historically tight inventory market. If someone's looking for something specific in terms of school district, bed and bath count, neighborhood, street that they want to live on, it can be hard to get that property and get it under contract and then time it up with interest rates, right?
Yeah, you can't time anything like that. I mean, here's the thing is like, I don't think there's a rush to go out and buy a home because I like we've discussed many times. I think home prices have somewhat settled and I don't think they're going to go far in either direction. But it is about finding the right property, right? I mean, I listed a property last week in Cyprus and 3 offers in 2 days and we're $100,000 over the asking price when I thought there was a chance we'd go $30,000-$40,000 over the asking price just based on other comparable sales. So demand for that really high. I've got another property that's just kind of sitting, not getting the activity. So it really depends on what you're looking for in the market that you're in. So I think, this little drop in interest rates, we've seen it. It will spur a little bit. You'll see mortgage applications next week or whenever this data reports, probably see a little bit of a jump. It'll be positive. And that's because more buyers are just going to take advantage of that slight dip in rates. But I think the key here, get pre-approved so that when the right property does present itself, you're in a position to make an offer and you're not having to backtrack going, okay, now what do I do now that I've found the right one?
So Logan tracks the data in terms of applications, closings, and where they start to react to interest rates. So Mortgage News Daily reporting 6.63 today. 6.625 is sort of the inflection point where you start to see activity in terms of applications, properties going pending, picking up. And we're talking going to the moon? No, we're not talking going to the moon. We're at very, very low levels. So it doesn't take much for it to pick up. But that is the top end of that range where you start seeing people get more comfortable. So should see a little bit of pickup in activity here over the next week or two, unless we just turn around and give this right back. But when we move to 6.375, 6.25, 6.125, that's when I think you will see a pickup in demand. But Jeb, you may also start seeing a pickup in supply. Some of those 75% of sellers are buyers, and they start looking and going, okay, I can give up my 3.125 for a 6.125. I'm not doing it for 6.875, but I'll do this. So that's why we talk that supply demand balance. I don't know that it's going to get too out of whack. It's going to look similar to what we have right now. We may have more demand in the form of more buyers. We will have more supply in the form of sellers. So we could see more activity off of very low levels. But I don't know that we really see pricing pressure. But if we see rates continue to move lower, there's definitely a floor under what rates are going to do in most parts of the country. There are parts that are experiencing heavy influxes, increases in supply, mainly Florida, Louisiana, parts of Texas. But what are your thoughts on that?
Yeah, no, I agree. I think, and again, no rush, but that doesn't mean you can sit on the sidelines and just, throw lowball offers at properties because most people aren't willing to play that game. I mean, I've had properties that are sitting a little bit longer. We've had offers like that, and my clients are like, "No, we're not doing this." Go ahead.
I've got a fun story for you, Jeb, along those lines. We have a listener out in Phoenix market, which is one of those markets that's dipped. You probably have the numbers from Cromford. It's a little bit, it's not an excessive dip, but prices are down, and he's right in the middle of that price range where they've seen some decrease. I think the property was $469, and I believe they offered $409. $60,000 price cut, almost 15%. And the seller came back and offered a counter offer, dropping the price $500. So that's that's kind of in a nutshell most of these markets. You have a subset or a significant set of buyers who want there to be some sort of forced sale that where they can make one of these really low ball offers, and sellers are not necessarily clinging to their price. They're just saying, I'm not giving my property away. I'll keep it. We've talked about what are they calling it? Forced renters or unintended landlords. That people, many of them are choosing to just keep them in rent them out, and then go rent somewhere else or buy a house if they're capable of doing that without selling. So we don't have forced selling. We don't really have in most parts of the country sellers panicking. So if your agent can, find out what the motivation is. Does the seller want to sell, or are they in a divorce or death or inheritance situation where they have to sell? It'll give you an idea of what that leverage looks like.
Yeah, I think the important thing here is that rates have trended down a little bit. It's going to help out monthly payments, going to help out affordability a little bit. So if you're a buyer sitting on the sidelines, this kind of just helps. It goes in your direction. Doesn't need you mean you need to rush out and do something, but I do think, I mean, when we've seen this happen, all of a sudden there just seems to be a little bit more activity out there in the market. But I think for the most part, it's all about finding the right one, the right time in your life, all of the things that we talk about. So if you're in that position, you're going, getting pre-approved, want a second quote, want to go through the pre-approval process because you haven't, make sure you check that link scrolling in the bottom there, the educatedhomebuyer.com/start or jebsmith.net/start. Either of those will get you in touch with the team, guide you through the right, through that process. But if you have direct questions for Josh, want to get referred to a real estate agent, reach out directly. More than happy to get you guys moving in the right direction. But with that said, Josh, any final words for people out there shopping this weekend?
No, I'm pretty much right in lockstep with what you said. Had a listener reach out last night that for the purposes of writing offers, they got approved with Zillow Home Mortgage. He called, said, hey, we're under contract. Here's the offer. What can you do? I think we were an eighth lower in interest rate and $2,000 lower in fees before today's improvement. So it is not all about trying to find the rock bottom lowest rate and fee. We've gone through that a million times, but there's a range of what's reasonable, and you want to get knowledge and expertise. And if you're with Zillow or any of the other large call center lenders, you're not getting knowledge and expertise for paying a little bit of a premium with their very average interest rate. So if you have a quote from someone else, you want a second opinion, happy to look at it. If you tell me, hey, someone's taking great care of me, super attentive, answer all my questions, and the numbers look reasonable, we're more than happy to tell you, hey, you're in good hands, move forward with confidence. If we can save you some money, we'll absolutely show you that.
All right, guys, we'll continue to update you on the live next Wednesday, 5 p.m. So make sure you tune in then. If you have questions before then, reach out. But until next week, adios.
Amigos.